Hey, this is Sasha. Thanks for joining me in today's video. And today what I want to do is share with you is what is a Strangle strategy and how does it make you money? So stay tuned. I'm going to share with you some insight. All right, so if you're interested in understanding what a strangle is, it's kind of the basic block to understanding how to sell options for premium or for income. So when we look at a strangle strategy and we go in on screen here, what we're really aiming to do is we're eventually looking to sell option premium. Now at the beginning, what most people do and they think about it is like, let's say we go into about 23 days out on Home Depot right here, and I will go ahead and buy a strangle. So you can see these are split up or spread out a little bit. So it's strangling two different points. Strangle, straddle, they're very similar. Straddle's at the same point. So if we analyze this trade, if it may seem a little confusing, the way that it works is you're just buying two options here. Okay, so if you're buying a single call and a single put, and it creates this risk profile picture. Now this risk profile picture, this is your stock price here at the bottom. This is your profit or this is your loss, and this is the zero line. The white line is today, the green line is at expiration. You can see those numbers over here. And if you're struggling to understand those concepts, definitely check out the Getting Started with Trading Options on the website, tradersfly.com. And you can learn a lot more about option trading. There's some courses there as well. And you can also grab a freebie, free mini option trading course right there in our freebies section. So anyways, let's continue moving forward. One of the big downsides though to buying a strangle here is the theta or the time loss that you will incur here. So when you look at this, you're going to be losing $24 a day. So every day this thing moves or does not move, you're losing $24 a day. So now after about a couple week or two, you'll be down about $400, $378 right here. Okay, so that's a bit of the issue with buying a strangle. Now, when would you want to buy a strangle? You'd probably look to buy a strangle when volatilities are cheap, right? Because when volatilities are cheap, option premium is cheap, which means you're buying options. And if you can buy options at a cheaper price, that's a good thing. So then eventually when volatility picks up, it's going to move either up or down. You'll be in a better spot. Okay, so let's look at really the base concept of what this is teaching you or setting you up. With options, you could be a buyer, which is what we're doing here, or you could actually be a seller. You might think, how can I sell first? Well, you could sell something on eBay first, but if you don't have it, you better go get it at the store, right? If I sell a brand new camera, like a brand new Canon camera, then I could sell it even though I might not have it. And then if it sells for, let's say, $3,000 and I could pick one at the store up for $1,000, then I'll be profitable. Not that that would probably happen, but the point is you could still be a seller first. So here what we can do is be a seller first, and we'll sell first and we'll buy this back later. And what you'll notice here is the theta or the time variable here flipped to positive 24, which means now as you look into this, every day this moves or does not move, you're making $24, okay? And then that continues to accelerate. So that's really a great thing when it comes to the premium. So this is the starting point to selling options for monthly income and for premium. Now, what you can do with this strangle, let's say I widen it out and I go to the 340 and I go here to a 280, and now I go wider. So now you've got a much wider strangle, but you make less because it's kind of safer. It's in that spot. And once that expires, you collect all the premium. Now, could you get out of it earlier? Sure you could. Could you stay in it for 5 days? Sure you could. It's up to you, but this is the base starting point for monthly income. What's the next step beyond this? The next step I would say is looking at an iron condor. So here I've got the 330 and the 300 strike. So what I might do is buy a single to protect it. That way I'm using less capital. And this is where they call like other strategies like J lizards and all kinds of stuff. Not that you really need to get into that, but here's another single over here on this side. And now I've got my construction kind of for an iron condor. It's the same concept, I'm just limiting my risk a little bit. And if you're struggling, definitely check out the freebies section here and the courses. We've got a whole course on iron condors as well. That's I think about 20 hours long. So it's very detailed. Check that stuff out on our website. But with that being said, that's really the strangle. You really typically want to sell strangles, and the time to buy a strangle is when volatilities are very, very cheap and you're okay with the theta hit. That's kind of the approach you may want to take a look at when you're dealing with strangles. So thanks for stopping by. Hope you enjoyed the video, and feel free to grab some of those freebies on the website, subscribe to the channel, or check out more great videos from here. Thanks again, and I will see you in the next one.